Welcome, ladies and gentlemen, to the Cima SCS P3 Complete Essentials Revision. This segment is segment number 2 of the series, where we will look at risk management. Let's have a look. So before I get started, I want to quickly give you a kind reminder or a few suggestions. Please have a notebook and pen on the ready. Follow the slides and my explanation carefully. Make notes as you deem necessary. Also maintain a list of key topics that you feel you're weak at, so you can self-revise later or even bring them up in the live sessions. And maintain a list of key performance and management tools that can help model answers in the case study exam. On that note, a quick reminder on the core activities. As you know, P3 relates to core activities D and E, D being evaluating and mitigating risk, E being recommending and maintaining a sound control environment. So predominantly this particular segment is going to be focusing on the risk management aspect, which closely associates core activity D, evaluating and mitigating risk. So let's get started. To start with, what is risk management? You have to understand, and first let's take a look at it through the definitions. There are many. On the one end, you have risk management being defined as the process of understanding and managing the risks that the organization is inevitably subject to in attempting to achieve its corporate objectives. So that inevitable kind of downside or the inevitable negativity surrounding the operations of the business when you are trying to achieve the corporate objectives is one way of understanding risk, or rather risk management. It usually involves minimizing the impact of downside risk by conforming, while also maximizing the opportunities within the upside risk by performing. So technically, risk management is all about finding or hitting the right balance, because in conformance what you're trying to do is you're trying to control the threats or hazards, because you understand that bad things do happen. On the performance aspect of things, because good things might not happen, you're trying to maximize your return or the opportunity of any positive situations. So you're trying to perform. So good risk management or sound risk management is striking the right balance between conformance and performance. Now, if you really look at the syllabus, the entire syllabus is structured as far as risk management is concerned on the basis of this. What you see here, enterprise risk management. So it's very important as case study students and as potential management accountants, chartered management accountants, you have a very good handle on what enterprise risk management is. Now, enterprise or ERM, the initial definition and the initial proposal was made by the Committee of Sponsoring Organizations of the Treadway Commission in 2003, which we generally refer to as COSO. So COSO defined ERM as a process effected by an entity's board of directors, management and other personnel, and they apply this process in strategy setting and across the entire enterprise, designed to identify potential events that may affect the entity, manage risk to be within its risk appetite, to provide reasonable assurance regarding the achievement of entity's objectives. So this entire process is supposed to deal with potential events, manage risk within the appetite, and provide reasonable assurance regarding achieving the entity's objectives. There are key principles under ERM. One is consideration of risk management in the context of business strategy. Then risk management is everyone's responsibility with the tone set from the top. The creation of a risk-aware culture, a comprehensive and holistic approach to risk management, consideration of a broad range of risks, strategic, financial, operational and compliance, all different categorizations of risks, etc. A focused risk management strategy led by the board, embedding risk within an organization's culture. These are the key principles that fall within the enterprise risk management framework. Now, The initial suggestion or the initial representation of COSO's ERM was done through the form of a cube. It's a 3D matrix in the form of a cube which reflects the relationships between objectives, components, and different organizational levels. So in the cube, you find 4 levels, 4 objectives, and 8 components. This is the cube, which I'm sure you're familiar with. So on the right here, you have the 4 levels: entity level, divisional level, business unit level, and subsidiary level. Here on the top, you have the 4 objectives: compliance objectives, reporting objectives, operating objectives, and strategic objectives. And then you have the 8 components: internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication, and monitoring. These are the 8 components embedded across the 4 objectives within the 4 levels. So basically, ERM means that you are supposed to do all of this. You're supposed to engage in all the 8 components across the board. That's what ERM says. However, COSO updated its ERM framework, the cube, to a double helix in 2017, the DNA format. The cube updated to form a double helix with the key principles that ERM should be ingrained into everything the organization does, including setting the mission, vision, and the core values of the entity. So in the double helix, the framework was slightly adjusted to denote 5 components integrated throughout 5 strategic activities. That is what you see on the screen is the double helix. So here you basically have 5 strategic activities here embedded through 5 components. So what are the 5 strategic activities? Mission, vision, and core values is where everything starts. Strategy development, objective formulation, implementation and performance, and enhanced value. Whereas the 5 components: governance and culture, strategy and objective setting, performance, review and revision, information, communication, and reporting. So basically, you're supposed to conduct all the 5 strategic activities by applying all the 5 components. This is what you're supposed to do, or this is what COSO slightly adjusted and pitched the enterprise risk management framework as through the double helix format. So have an idea about their perception of what the 5 components and what the 5 strategic activities are. And please note that now in the updated version, there is a core focus that you have to offer enhanced value to shareholders. That's the main idea. Right. Now we talk about the formulation of risk management strategy. A risk management strategy needs to be developed to ensure that the risk exposures of the organization are consistent with its risk appetite. So at the very least, the risk management capability within the organization should be sufficient to review its internal control system and its adequacy at least annually. You'll actually see the term annually getting repeated a lot because there are annual reviews all the time. Even in this case, the risk management capability should be able to review the internal control system. It should ensure that controls are properly implemented and monitor the implementation and effectiveness of those controls. What are the critical elements? Here you have some very critical and very important terms you should have a sound understanding of as a good risk manager. So everything starts with the business strategy, which is what the company will do. And then you understand that every company will have a risk appetite. That is how much risk the business will accept. Now, risk appetite is the combination of 2 other aspects. One is the risk attitude, that is basically risk averse or risk seeker or risk neutral. People have different risk attitudes. So that is one aspect. What is the overall approach to risk? On the other end, the risk capacity, maximum risk the business can accept. Now, there is a very key difference between risk appetite and risk capacity. The best way to understand it is, especially during the COVID-19 environment, for example, right? It's a difficult situation. Now, in such a situation, there can be a company with a high level of risk capacity. The maximum risk the business can accept can be very high. They might be highly liquid, but their risk appetite, the amount of risk the business will accept, can be low. They can have a lower risk appetite because the external environment deems the situation to be challenging, and therefore their risk attitude might be a more risk averse one. So you mix a risk averse attitude with a difficult external environment, and therefore even a business with a high risk capacity might have a low risk appetite. When you're analyzing questions, when you're analyzing the pre-scene, when you're understanding the business and the sentiment of the leaders of the business is very important, you understand the level of attitude, capacity and appetite they have. On the other end, the risk strategy is ultimately the overall, basically what we are discussing here, the setting up of how you will manage the risks. And after you do everything, after you take all the measures that you can to manage the risk, you're going to end up with certain amount of risks that cannot be managed, which we refer to as the residual risk element. Now let's take a look at the features of risk management strategy. Now the Cima IFAC joint report on enterprise governance in 2004 established several key features. One, statement of the organization's attitude to risk, that is the balance between risk and the need to achieve objectives. The risk appetite of the organization, the objectives of the risk management strategy, culture of the organization in relation to risk, and the behavior the organization expects from individuals with regard to risk taking, and the responsibilities of managers for the application of risk management strategy. So here you have the key features, including the reference that should be made to the risk management systems the company uses, that is its internal control systems, corporate governance related matters, anything that can act as a reference within the risk management system that informs the stakeholders better. Then the performance criteria should also be defined so that the effectiveness of risk management can be evaluated. Those are the key features that Cima and IFAC issued in their joint report of a sound risk management strategy. Then, one of the most initial stages of risk management, overall risk management strategies, the identification of risk. The risk identification process will often be controlled by a risk committee or risk management specialists. The risks identified in the process should be recorded in a risk register, which is simply a list of the risks that have been identified and the measures, if any, that have been taken to control each of them. In fact, that would be the most simple form of a risk register. The list of the risks, identified risks, and the measures that have been taken to control them. So basically, in most pre-scenes, that is the form we see. The risk register has been presented to the learning partners by the examiner. Now, as you identify and as you go through the analysis of the risks, you realize that there is an interrelationship between risks. That is very, very important. Risks are often interrelated. This means that if one risk is more likely or will have a more significant impact for an organization, then it may be more likely to be exposed to other risks or more susceptible to other risks. Now, a good example is, in many cases, you take risk types like compliance risk, environmental risk, fraud risk, litigation risk. One thing is that all of them lead to each other. They are all connected. And on top of it, all of them most commonly lead to reputational risk, which is a very serious matter. So to be effective risk managers and manage risk smartly, it is important to develop a keen sense of this nature of the risk interrelationships. That's why it's very important to keep an eye on the kind of feedback, feed-forward loops that these different risks that your business is exposed to creates. Another consideration in the interaction between risks is the combining of the risks. Sometimes for the end result to occur, multiple risks have to combine, right? So you can there is an upside to it and there is a downside to it, because higher the risk, higher the return. So if you're taking in tandem, if you're trying to exploit an upside opportunity, you might have to combine certain risks. On the other end, if you have a downside situation, if risks are combined, then your exposure to risk can be high, and then the threat level of those combined risks can be higher than any individual risk that is there. You have to have a understanding of that aspect as well. One common treatment of risk is diversification, and the idea of creating a portfolio of products or services to help manage the risk. This is another example of how risks interact. So that common saying, many eggs in many baskets, is a good example of diversification where you are trying to manage the risk. Now let's focus on risk identification itself. Now there are a variety of methods that can be used by businesses to identify the risks that they face. Here you have a basic and one of the most simplest ways of mapping the different ways that you have at your disposal to identify risks and classify them into even a risk register. You can classify them as internal and external risks, reactive and proactive situations. So proactive is before. You're doing this before something goes wrong. Reactive are things that you can do after something goes wrong, after your risk exposure has become visible. On the other hand, you have the internal techniques where you can do within the company related to the internal environment, and you have external sources and external situations and circumstances that you tap into. Let's take a look. Starting by proactive internal methods, you have brainstorming, pest analysis, SWOT analysis, objective and the strategic choice discussions, staff interviews and questionnaires, scenario planning, all can be proactive internal techniques. Proactive external techniques could be reaching out to external advisors, consultation with shareholders, mandatory and statutory target setting, benchmarking, etc. Right? There are external benchmarking. There are indeed internal benchmarking methods, which is internal benchmarking, but there are process benchmarking, industry benchmarking. There are external methods of benchmarking that you can deploy. In the reactive side, external methods of reactive approaches is health and safety reports, recommendations of professional bodies, external auditor reports, and customer surveys. Whereas internal methods, you can conduct internal audit inspections, complaints, incidents and claims, etc. can be used. Now, once you do the risk identification and the initial analysis, these identified risks, as I explained, go into the risk register. So it's important we understand what the risk register is. It is a very important and practical risk management tool that should be used by all companies. It needs to be reviewed and updated regularly, often annually, in conjunction with corporate governance guidelines, often laid out in the form of a tabular document with various headings. So while earlier when I introduced the risk register, I just said that listing the identified risks and mitigation methods are the only thing. In fact, the risk register can be far more detailed. So some of the example headings you can have are the risk title, likelihood, impact, should it arise, the risk owner, the date of identification, overall risk rating, further actions that you could take, action lead's name, due date, risk level target, and mitigation action. These are all different things you could include. The level of detail is up to you. It's a voluntary document, not rather it's a voluntary in the sense of the level of detail you would provide. Because if there is a risk committee and if there is an audit committee, you are definitely supposed to have a sound risk register which needs to be regularly updated. This is one of the most critical documents as far as the strategic case study is concerned, that gets referred to all over the place and is also almost always, 99% of the time, almost always offered in the pre-scene in the form of a annexure. So it's very, very important. Next, we look at risk management strategy, the quantification aspect. So when we understood risk, right, the initial discussion in segment 1 is we understood that risk is always something that has a predictable nature to it, and therefore you try to quantify it all the time. Quantification of risk is important in understanding the extent and significance of the risk exposure. This can be done by measuring the impact of the risk factor, such as exchange rates, on the total value of the company or on individual items such as cash flow or costs. Now, some quantitative techniques include, let's take a look at them. Most of these you would have already seen or learnt at some stage in your Cima or management career. Expected values, which is a measure of probability of occurrence. Then you have standard deviation, which is a measure of spread. Variance, covariance, which are measures of volatility. Value at risk, which is a measure of probability of an event or set of events occurring. Then you have regression analysis, which is a measure of correlation between the variables for trend analysis, right? How strongly are these points correlated? Simulation analysis, which basically simulates different scenarios like business value by tuning variables to different parameters, embedded even in Microsoft Excel. Scenario planning, again, you can find it in Excel and various data visualization softwares, which allows us to forecast various outcomes of an event. Decision trees, which is the use of probabilities in a more graphical sense to estimate an outcome. Sensitivity analysis, asking the what if questions to test the robustness of a plan. So while the case study doesn't really get us to do the numbers, we are definitely supposed to have a fair understanding, at least at this level that you see on the screen, of the kind of tools that are available for us that can help us quantify the risk that the business is exposed to. Then you have the qualitative analysis aspect. The best way to do this is risk or assurance mapping. A common qualitative way of assessing the significance of risk is based on likelihood versus impact analysis. So you know the very famous TARA framework also is an outcome of likelihood versus impact analysis. Let's first look at the key features and the process involved. Here, the board, the risk committee, if there is one, or the audit committee and senior management from various departments will all be involved in the preparation of the map. And the map identifies whether a risk will have a significant impact on the organization and links that into the likelihood of the risk occurring. The approach can provide a framework for prioritizing the risks in the business. And risks with significant impact and a high likelihood of occurrence need more urgent attention than risks with a low impact with low likelihood of occurrence. So urgency can be decided based on the level of impact and the level of likelihood. A well-structured risk map will highlight where there are gaps in assurances over significant risk areas. Also, duplicated or potentially burdensome assurance processes could be identified. Now, while you can map the risk and come up with a number of, or rather there are a number of methods that can be used to treat risk, these methods will limit the risks, and the overall risk management strategy can define how the risks will be managed and the way these methods will interact. Methods of treating or facing risk: avoid risk, you move aside. Transfer risk, you shift elsewhere, shift the risk to some other party. Transfer. Pool the risk, basically mixing and managing the upside versus downside and even netting them off against each other, pitting them against each other. Then diversify, many eggs, many baskets. Reduce, that is trying to control and comply to minimize impact. Good example is internal controls that you put in place within your company. Then risk hedging, basically mixing the risk exposure through financial instruments. Risk sharing, that is collaborating to share. For example, strategic alliances, joint ventures, licensing arrangements, etc. can be noted. Now, what can we do if we combine mapping and responsing together? Risk maps can provide a useful framework to determine an appropriate risk response, and the TARA framework is one good example. Here you have the TARA framework where the likelihood and impact matrix has been matched with a response strategy. So if your likelihood is low and your impact is low, you can accept that risk here. If your likelihood is low but your impact is high, you can transfer or share that risk. Whereas when your likelihood goes up, when it's more high probability, when the risk is of high probability and your impact is low, you can try to reduce it. But if your likelihood is also very high but the impact, especially the downside impact, is very high, the best thing would be to try and avoid. This leads to the TARA framework. So transfer, accept, reduce and avoid, TARA, TARA framework, which is a mapping plus response matrix that has been developed, which can be a good starting point for coming up with effective risk management strategy. In addition to, now most of the discussion that we have done so far is all stemming from the ERM approach, right? The enterprise risk management approach, originally the cube, now the double helix. But there are other alternates. One of those alternates is called the risk cube. Now in the risk cube, the total risk equals the volume of the entire cube. So as you can see here, this entire cube represents the total risk. Risk is seen as some combination of a threat here, exploiting some vulnerability here, and that could cause harm to an asset here. That combination is what you see as the total risk. Now what you do is you try to take different measures to reduce this risk, to manage the risk. There, the residual risk becomes the combined function of leftover risk after threat reducing safeguards, vulnerability reducing safeguards are implemented. So once you do what you can to counter these different values, whatever is left is what you denote as the residual risk. There are other words to this net risk, etc., which we will come across, but it's all residual risk is the key word that you have to remember as the risk that is left over after you have done everything that you can. Now we arrive at risk reporting. Embedded within, even in the COSO framework, the ERM framework, you would have realized the 8th component was monitoring, but you can't just monitor, it has to get reported. So risk reporting is fundamental, even in the reactive aspect of things, but also in the proactive aspect of things. Risk reports now form part of an annual report by many global economies. It has become an important disclosure requirement. A risk reporting system would include a systematic review of the risk forecast, at least annually, a review of the risk strategy and responses to significant risks, a monitoring and feedback loop on action taken and assessments of significant risks, a system indicating material change to business circumstances to provide an early warning, like a signal, the incorporation of audit work as part of the monitoring and information gathering process. So basically, while it is an important disclosure, it is also noted that it has to provide so many different aspects, or it has to provide the visibility in terms of all these different perspectives. Then we arrive at risk management strategy evaluation. Obviously, once you have a strategy in place, you need to continuously evaluate it because you need to identify gaps and close them if there are. Once the company has established its risk strategy and decided in what areas it will reduce its risks and the methods it will use to achieve the desired reductions, the strategy should be evaluated. The purpose is to understand if the strategy has achieved its objectives. So within the risk management strategy, the target should be included to enable the company to assess whether the risk strategy objectives have been achieved. Then, do the benefits outweigh the cost? Within the risk management strategy, the costs and the benefits of risk measures, like for example the internal controls, must be evaluated, and you also have to do a cost benefit comparison. The evaluation process is based on the principle that the costs of a control measure should not exceed the benefits that it provides. So evaluation, you're basically asking two questions. One, has the strategy achieved the objectives? Two, do the benefits outweigh the cost? Then we arrive at this slight discussion that even I mentioned earlier, the net risk component, the residual component. Then you can look at the embedding of this information in a risk report by presenting both the gross risk and the net risk. So as the terms themselves, gross and net, suggest, gross risk is an assessment of risk before you apply any controls, transfer or management responses. The total, the gross. The net risk is the residual risk, which we looked at even in the cube, which is an assessment of risk taking into account the controls, transfer and management responses. That is, after any controls have been implemented to facilitate a review of the effectiveness of risk responses. If the residual risk is considered to be too great, then the company will need to either not expose itself to risk situations or put in place better controls over the risk. And the amount of residual risk a company can bear is ultimately a management decision. It is possible to measure that residual risk possibly as a proportion of profit, capital or turnover in order to help management make that judgment. So now this is all very subjective, because when you really think about it, especially if you are focusing on the residual risk component, it's what is left over after you have done everything. No, but there is always that subjectivity concern to say, have I done everything that I can? Or because you can always, not everyone sees all the aspects. So if you don't have many people involved, and if you don't have all the best practices with respect to risk management and the necessary expertise even, you might not have done everything that you could have done. In that case, your residual risk is at a level that is greater than where it can be. That is why you have that kind of idea there. We want to try and manage the residual risk at a minimum possible level, or we need to maintain it at a minimum possible level, which means we need to do everything we can to have an effective risk management strategy in place. Then we arrive at the roles and responsibilities. Now, we've talked extensively about risk management strategy, but who is going to do all of these? To be really honest, all employees have a role and responsibility for risk. You should be aware of possible risks through policies issued and training given, and you should be audible if you believe a risk needs to be managed by reporting it to your manager or even by whistleblowing. If the company being considered is divisional, there may be even a risk officer for each division who will help to identify and manage tactical and operational level risk. So if we focus our attention on a few key stakeholders and what their responsibilities involve, let's start from internal audit. Let's go along this sense. So obviously the audit committee, if there is no risk committee, the audit committee will be there. The board committee with responsibilities for reviewing internal control systems and working with internal and external auditors. So they are the ones who are basically in charge of almost all aspects of risk. Now, if there is a risk committee, then if a risk committee does not exist, as I said, audit committee will absorb it. This is a board committee with direct responsibility for risk management. If there is a risk committee, if not, that work will slowly get absorbed into the audit committee. Now, the risk committee works through a risk management team, and the risk management team is led by the risk manager himself. What does the risk management team and the risk manager do? They are a group of senior and middle management with operational responsibility for carrying out the risk management process. They report to the board through the audit or risk committee. They identify risks, they manage the risk register, they monitor the effectiveness of the overall process, and even make recommendations for improvement. And one independent team that provides oversight support to the audit committee even, is the internal audit team. They are involved in the review of internal controls, support management in the risk management process. while you have all these different stakeholders, the board of directors take the ultimate responsibility for risk management. End of the day, if something goes wrong, it's the board of directors who have to take responsibility and who have to answer the shareholders. They also define the risk appetite of the organization. Remember, the combination of risk capacity and risk appetite. So the decision of the risk capacity, risk appetite will be made by the board of directors. That brings me to the risk committee. What are the aims and objectives? So again, I want to remind you, the risk committee is one of the independent board committees that can be there if you have a large company and if the need is kind of too big, or else the audit committee takes care of these aims and objectives. So if you really think about what the risk committee does, there are a number of aims and objectives which you can see on the screen. Let's take a look at them. The risk committee raises risk awareness and ensure appropriate risk management within the organization. They establish policy for risk management. They ensure that adequate and efficient processes are in place to identify, report and monitor risk. They update the company's risk profile and they report to the board. They make recommendations on the risk appetite. They advise the board on the risk profile and appetite, and as part of the process, they oversee the risk assurance process. They act on behalf of the board to ensure the appropriate mechanisms are well in place with respect to identification, assessment, assurance, and overall management of risk. They do continuous reviews of the company's risk management policy, including and making recommendations for amendment of that policy. They ensure that there is appropriate communication of the risks, policies, and controls within the company. They ensure that there are adequate training arrangements in place so management at all levels are aware of the responsibilities. And where necessary, they obtain appropriate external advice to ensure that risk management processes are up to date and appropriate to the circumstances of the company. They also ensure best practices in risk management are used by the company, including obtaining and implementing external advice where necessary. So as you can see, the risk committee, if there is one, when there is one, they basically are the key team that hands-on does everything related to risk management strategy. This risk management, well, the risk committee works through a risk management team, and that team is headed by the risk manager. Now, the risk manager, what are the activities the risk manager does? Let's take a look. So the risk manager provides the overall leadership for the risk management team, obviously. Identify, evaluate of risks affecting the company arising from that organization's business, operations, and policies. The risk manager implements the risk mitigation strategies, including appropriate internal controls to manage identified risks. The risk manager seeks opportunities to improve risk management methodology and practices within the company. Then also monitoring the status of risk mitigation strategies and internal audits and ensuring that all recommendations are acted upon. So leadership, developing, implementing and managing risk management programs and initiatives, including establishment of risk management awareness programs within the company. Also has to maintain good working relationships with the board and the risk management committee, board committee, ensuring compliance with any laws and regulations affecting the business. Implementing a set of risk indicators and reports, including losses, incidents, key risk exposures, and early warning indicators. Liaising with insurance companies, particularly with regards to claims, conditions, and cover available. Depending on specific laws of the jurisdiction in which the organization is based, that country. Working with external auditors to provide assurance and assistance in their work in appraising risks and controls within the company. And again, depending on the jurisdiction, producing reports on the risk management, including any statutory reports, like for example, in the US, the SOX, the Sarbanes-Oxley Act, has a mandated set of statutory reporting with respect to risk management. The risk manager of the company will be the one who is going to be the leader and in charge of ensuring that those kind of statutory responsibilities are also met. And then risk manager works through reports to the board through the audit committee. anyway, or the risk committee if there is one. So there is always that connection that is all related to good governance, corporate governance. And that marks the end of the risk management segment. We looked at a number of important things here. We first understood what risk management is, the mix of conformance versus performance, and started by looking at enterprise risk management by COSO. Then we looked at risk strategy, the various keywords that you're supposed to have an understanding of, and the features of a good risk management strategy. Then we started looking at risk management cycle. So other than the Cima suggestion, which we looked at in, I think, segment number 1, here under risk management, we looked at various stages of risk management, identifying, assessing through quantification and mapping, responding to risk, implementing and allocating responsibilities, the monitoring of controls. Anyway, we will be looking at internal controls in much detail in a separate segment, and even review, that is evaluating risk management strategy. How do you evaluate and decide whether it's good or bad? That is what risk management is all about. As I always say, do keep learning and enjoy the process. Ladies and gentlemen, thank you very much for tuning into the segment. I hope you have a very sound understanding of what risk management and what risk management strategy involves, and hope that it also will make you better risk managers down the line in your personal and professional life. So thank you again for tuning in. Happy learning. I will see you in a different segment or elsewhere. Thank you very much.